Sweet.
Just All right, everyone, good evening. Today is Monday, October 12th, and let's run through the market news of the day. All right, big tech surge. That's the most important story we are watching. With the surge in technology stocks leading US gains, the Chinese yuan extended its decline following steps to curtail its rally, which we'll dive into in a bit. Looking at the US equity markets, though, we see that the S&P 500 was up 1.64% and the Dow was up nearly 1%. In addition, the Nasdaq was up a little bit over 2% for that strong outperformance. Considering commodities markets, we see a supply shock in oil, with the U.S. Gulf heading back, or the producers in the U.S. Gulf region heading back following Hurricane Delta's landfall, and Libya taking a major step towards reopening its biggest oil fields. This comes after the past controversies, and it does look like that they are going to move forward with the oil. WTI prices fell 2.7% in the US session to 39.52 on the news. Emerging markets are on a 6-day winning streak and look set to continue with futures up across the board right now. All right, so for eyes on China, we've got two things that we'd like to talk about. Firstly, with regard to Chinese coal, the Australian dollar slid sharply amid reports that China has suspended purchases of Australian coal. Chinese power stations and steel mills had been verbally told to immediately stop using Australian coal. This serves to be an escalation in tensions that have already jolted agriculture exports from China's biggest supplier of commodities. China is the top consumer of Australia's coal, which accounts for almost a quarter of all of their exports. So it's very substantial. Exports were already forecast to fall from 23 billion Australian dollars to 16.6 the equivalent of 16.6 billion US dollars in the 12 months to June 30th this year, from 35 billion Australian dollars a year prior. So this is 35 billion to 23 billion. So big sharp fall there. Obviously, not surprisingly, this is on the heels of tailwinds of weaker demand and also lower prices across the board. China is the #2 destination for Australia's thermal coal exports, going right behind Japan. The annual exports in that market in particular are projected to slide to 15 billion Australian dollars from 20 billion Australian dollars in fiscal 2019. Also, China is the key buyer of Australia's most lucrative export, iron ore. This curbs on this product would be a heavy blow to a steel industry that relies on vast and cheap supplies from mining heavyweights like Rio Tinto Group and BHP Group. For the second story on the screen, we see a sinking yuan, sinking RMB. Is falling after the PBOC responds to the biggest rally in 15 years. The onshore traded RMB fell as much as 1% to 675 against the US dollar. Lenders would no longer be required to hold reserves when buying foreign currency forward contracts, which obviously directly affects the demand for the currency and in turn the foreign exchange rate. The RMB jumped as much as 1.5% against the greenback on Friday to reach 6.7 RMB. Also, China's CSI 300 index of blue chip stocks, which is kind of their version of the S&P 500, gained a little bit over 3% on Monday. The Hong Kong benchmark, the Hang Seng index, added about 2.2% on the news. Also, while authorities said that they will tolerate some strength in the RMB's global role, as obviously its role does decide to grow as people do want to be in Chinese currency, especially on the tailwinds of the basis trades we've been talking about with the dollar carry, where you're selling the dollar because assets here are cheap and it's cheap to borrow here, and then buying things in emerging markets such as China. Authorities in China remain uncomfortable with sharp rallies that could threaten China's economic recovery, coming obviously out of the coronavirus crisis. All right, to move on to 3 micro stories of the day. The first one that we want to touch on is the SoftBank SPAC. The SoftBank Vision Fund is a planned blank check company, which has an unknown target size, but is likely to include money from both SoftBank and outside investors. The Vision Fund is known mainly for investments in startups, which obviously includes some very famous cash flow negative ones, such as Uber and WeWork. The fund has raised over 100 billion US dollars from Saudi Arabia and other investors. And obviously, again, famous for raining cash on things that are not yet profitable. So today there's a conference at Bloomberg, and in response to the NASDAQ options whale claims that we've seen, where they've had these huge unrealized gains in trading, like literally prop trading equity options for tech companies. Some of the senior leaders at the firm mentioned today that nobody buying 10 billion of NASDAQ in a few weeks is going to actually move the NASDAQ, given the proportion of their volumes compared to the size of the market as a whole. So they had a humorous quote, "We are not even a dolphin, forget being a whale." So the idea is they are not really moving the markets. It's questionable if they are having an effect. And obviously, again, seeing the rally in tech today, it looks like that's set to continue. Obviously, it would be remiss if I didn't note that this has been a huge year for SPACs, given the market volatility, where this allows companies to go public via merger instead of doing an IPO through a typical roadshow process. This means that more than 100 SPACs have been created, raising over 40 billion US dollars on US stock exchanges. One of the Vision Fund's own companies, Opendoor, actually said last month that it was going public through a merger with a blank check company, which again is a synonymous term for a SPAC, led by Chatmouth Palifia, a prolific SPAC manager and a famed asset manager. So to continue, we see the Twilio acquisition. They're buying the consumer data startup Segment for $3.2 billion in stock. This will help Twilio compete in a total addressable market of 79 billion US dollars. Twilio shares rose 2.4% on the news to 313.49, which means the stock has tripled this year. Segment was founded in 2011 and is a cloud-based developer that helps companies such as Glossier, International Business Machines, IBM, and Intuit provide better support and service by combining together all the different ways a company might collect data on their consumers. Basically, it aggregates things that consumers do in store, on a mobile app, and on the website. Segment will be continued to be led by their CEO and co-founder, Peter Reinhardt, and will become a division of Twilio. So Morgan Stanley was the financial advisor to Twilio, and then on the other side of the table, Catalyst Partners out in San Francisco, Menlo Park, was the advisor to Segment. For the last main story on the screen, we want to note that Royal KPN has a possible takeover attempt. So this is the Dutch phone company facing another hostile takeover attempt, now for 11 billion US dollars. However, this time it does have a stronger defense. So it's defended on two fronts. Firstly, there's a new Dutch law which establishes the company as a firm with high levels of national interest. This is coming out of off the tailwinds of all the controversies with Huawei in the US, and the US proceeding to campaign across the EU to ensure that Huawei would not infiltrate the national security interests of American allies. So because this is a firm with high levels of national interest, it will be definitely difficult to get approval. So this is similar to how when, say, T-Mobile and Sprint merged in the US, they had to go through many stages of regulatory approval. So this will be a similar process if the deal does get through. In addition, on the second front, we see that companies in the Netherlands are able to deter unwanted approaches by deploying independent shareholder foundations as a defense. So companies that have done this recently include Asco Nobel, Mylan NV, and Stork NV, which all use preference shares to fend off efforts by hedge funds to fire the board and sell off units, which obviously goes hand in hand with the very definition of what a hostile takeover is. So the acquiring target, the acquirer in this situation is likely to be EQT, which does have plenty of experience doing a lot of telecom deals. They joined with Digital Colony Partners to acquire fiber network owner Zayo Group in $8 billion deal in March. They also invested in Dutch telecom provider Delta Fiber, German broadband provider Deutsche Glasfaser, and Maltese operator Melita. So they could have a lot of operational synergies there and have the expertise needed to make that more profitable. EQT is the European private equity firm and is considering this takeover in what would actually be its largest ever acquisition. One more thing to note that's not on the screen is Disney's earnings after the bell today. They reported earnings and have now said that they're going to focus more, not surprisingly, on their DTC, their direct to consumer, and streaming business. This refocuses on the thriving Disney Plus platform, which will redouble its push to become a global streaming giant like Netflix. Kareem Daniel, who had previously headed up the consumer products within the theme park division, is going to take over the distribution channels of Disney Plus, which is particularly significant for their diversity initiatives at the firm, as he is a very prominent Black executive in a very white-dominated firm. Disney shares react very positively on the news, going up as much as 5.5% in late trading. And obviously, this is coming off the coronavirus tailwinds that have spurred a slowdown at its theme park and cruise operations. Obviously, again, last month they did say that they were laying off 28,000 workers, and they have not yet been able to open its parks in California. All right, that pretty much covers it. Just for some upcoming events and things to watch, JP Morgan, Citigroup, and BlackRock will report their earnings tomorrow, and results from Wells Fargo, Bank of America, and Goldman Sachs are all due on Wednesday. This is a big week for financials, and obviously coming off the tailwinds of the Q2 results that were cornerstoned by the idea of increased loan loss provisions. We'll look to see how those loans actually did perform, if there were as many losses as provisioned for, which there really didn't look like there were going to be because of things like definitions and special servicing. A lot of the loans were able to be sorted out. The UK Prime Minister Boris Johnson also set a deadline of Thursday to thrash out the outline of the EU trade deal. Obviously, this is coming off the Brexit tensions and the contentious situation there. The ECB President Christine Lagarde also will be leading off the virtual annual meetings of the IMF and World Bank Group through October 18th, so that'll be good to stay tuned for as well. In addition, tomorrow we'll see the start of trading for US government bonds, which obviously took the day off, given that it was Columbus Day. Outstanding. Well, looking forward to seeing you tomorrow. Thank you so much for tuning in, and yeah, see you tomorrow.